Thanks for joining me for another episode again today. I've just been taking a look at some of the things that have been going on in the market, especially when it comes to the stuff around Wall Street bets versus the hedge funds. It's all been interesting, so I haven't done any videos because of that, and I've been really thinking through my own thought process in the way I'm going to put the information across to you, because as things change, we should be adapting our techniques and what we're trying to teach people, and especially now we have to be very careful about the information we put out there to people. Okay, so saying all of that, I know a lot of people have been asking me to put a beginner video out there, and I just want to do a few things. I want to explore a few different ideas. So I think most of the people watching my videos would have already made the decision that they want to come into the market, they want to start investing or trading, but usually my own focus is around investing itself. So I choose great companies I think are going to grow in the long term, and I invest my money in those companies. So if we start off with number one, platforms. There are different types of platforms you can use depending on whether you're a trader or an investor. Those platforms would vary, so it depends on your personal circumstances as well as to what avenue you're going to go down, how much money you have available to start investing, etc. So if we explore the platforms I use as the initial starting point, I use Trading 212. That's my personal favorite. I also use the other one is Freetrade. That's another platform I use, and the third one is eToro. So you can, I'll probably put links down below so you can check those out. My personal favorite is Trading 212 because I do get 0% commission on there. I don't have to pay any upfront, but of course there's some costs I think hidden into each transaction, which I'll talk about in a few minutes. You need to make sure before you choose a platform that the platform you're going to choose needs to be regulated by the FCA, or they have some kind of account with the FSCS or regulations there. So you need to look out for those two. The FSCS basically make sure that they have some funds set aside for each client they have. So each client account needs to be, for most of the platforms I use personally, I've made sure that they do have that mentioned on their website, and they cover up to 85,000. So each client would have an account of up to that amount available if everything was to go bad, and they needed to make sure that they have some money available for each customer or client in that case. Maybe you want to try and identify how much money you have available, and that decision is going to come down to your personal circumstances. So when I started with £50. The first time around I lost that money really because I did not know, or I didn't find out enough about the type of account I was using. You need to be aware of the different types of accounts that you can get for these platforms. So for Trading 212 you can get a CFD account, which is cost for difference. You can do that research on your own, but that's basically using margin or leverage to be able to buy a seller security. So that typically is geared towards traders, people who do high frequency transactions on a daily basis or whatever. There are some additional fees that they have to pay in order to get access to these things, but I won't get too much into that because my channel is focused around investing. So that's the CFD account. The other one is an investing account that is geared towards general buying and selling of securities or stocks or ETFs. You can be taxed for capital gains that you make in dividends, etc. So tax taxation is still available on that one. Then you have the ISA, which I find to give me the best benefit that you can get in any stocks and shares account. So that's the stocks and shares ISA. And what that basically allows you to do in the UK is you can get up to 20,000 per year tax free. And that's every April, it rolls over to the new tax year. So in order to take advantage of it, you just make sure you maximize on the amount you put into that account in a given year. Okay, so that's what the stocks and shares ISA is. So those are the three different types of accounts you get in the UK. In the US, that would vary. I do know they have a Roth IRA that you can get access to, and that one is free of capital gains, the same as it is for the ISA in the UK. You're now ready to jump onto these platforms and start investing your money. So you would probably think of a few different things: what companies you're going to choose, how much money should I put in, all of that becomes relevant. However, the point of amount of money, I think, does not matter that much, because, well, I mean, depending on the platform you're using, if you're using something like a Hargreaves Lansdowne or Vanguard, etc., all these vary. But if you're using Hargreaves Lansdowne, I think is the next best, well, it's the first best option that I would go on if I wasn't using a commission-free platform. So for Hargreaves Lansdowne, I think they charge you an $11.95 per transaction if you're gonna buy or sell a stock. I know definitely for buying it's an $11.95 fee, and that's a flat fee. And they might have some annual charges, I can't remember off the top of my head. But for me, if I was going to have more than 50,000 in my accounts, I would definitely move some of that money to Hargreaves Lansdowne, because I feel it's more secure in terms of they've been around for a very long time. They have a much better reputation with bigger clients, so they'd have to make sure that everything is on top. Okay, so how much do you need to put in? I think as a good start, when you're just new to everything, if you can spare $50 or £50, put that in. Choose one company. You can buy into fractional shares these days, so you don't really have to worry that you can't buy a whole share. No, not every stock and not every platform offers this, but now I think most platforms offer fractional shares these days. So you put your $50 in. Say for example, you're buying Apple, and Apple is at, I can't remember off the top of my head, but something like just over $300 per share, and you can only put $50 in. That's just a fraction. So you put that $50 in, but in the meantime, so that's a company we already know, so it makes sense to choose things that you're already familiar with, so you don't have to do too much research as a beginner. But you do want to eventually get to a point that you understand as much as you can about that business. So you choose it, you really focus your energy on learning and understanding how the market works and what these companies' performances are like, and just dig into as much information as you can. Now, I won't get into things like looking at balance sheet and so on as yet. I think that will come later on as you progress. So that's picking your first company. Now, what other companies might one look for? So I basically believe in the premise of sticking to what you already know. So don't overcomplicate the process. And we used to have a thing in college, a term I learned was KISS, keep it simple, stupid. Okay, that comes from a military term, but really just focus on keeping it simple. Stick to things you already know. If you're a person who likes makeup, you can probably look at a makeup company that you're already familiar with and buy into that. If you're familiar with designer brands, choose something in that area. If you're a person who works in the field of energy or technology or even plumbing, etc., whatever it is, doesn't matter. Choose something you know and understand as a very good first point to start. And that's basically it. So to summarize, we did speak about platforms. So one of the things I didn't touch on before was some of the other platforms. So I spoke about the zero commission fee platforms that I use at the moment, but they're basically to get me from one point of beginning into more advanced areas. So once I get to a point where I have a certain amount of capital, which I've set myself to about 25 to 50,000, then I'll move over to using Hargreaves Lansdown as my main platform. They do charge a fee per transaction, but at that point I'll be making bigger transactions. So I'll be making, in a single transaction, I'll probably be moving 1,000 plus pounds to make it worth my while for paying that 11.95 fee. But I just feel like it gives me the additional security, the peace of mind, knowing that my money is safe in something that has existed for so long. And they've basically been through the rounds of regulation and so on. So they're much more established in that way. There are other platforms as well that you can use that use robo trading. So effectively they'll have algorithms working in the background to choose for your style. So if you choose that you want slow growth or security, they have a portfolio designed for you. If you're a more adventurous investor, you can buy into that one as well. But I think it's always worthwhile to remember not to just choose a single platform and stick with it, especially because we don't know what can happen with some of these platforms, as we saw with the Robinhood fiasco and trading to one to Freetrade. They were basically forced by their third parties to shut down trading on certain stocks. That wasn't a very good look. I was shut out from Freetrade from using nearly all the US stocks available on their platform. But I did have other companies other than those AMC and GameStop that were traded. I did want to buy some, add to my Apple and my Tesla position, simply because I allocate funds every month to adding to my positions, and I was basically shut out. So that didn't feel too good for me, and it reinforces my point of operating on different platforms. So I was able to go on to eToro and trading to one to and place my orders on these companies. So that's first important point as I recap there. Also be aware that it's best to use your own knowledge. You do not lean on other people to bring you information. You should, before you put your hard-earned money into companies, you should think about it long and hard enough about where you put in your money. This is not a get quick rich type of scenario. You have to be willing to put your money there into a good cause, into a great cause, and allow your money time to develop and grow as the companies drive benefit for you. So as an example of some of these scenarios, I put one of my first big investments was Tesla, and I could see the value of the future that Tesla will have. So I decided I'm going to put my money here into this company, and as they deliver value to customers, I will get back that value in capital gains, and possibly dividends will outweigh into the future. So you have to be able to sit back and remove yourself from the scenario of just looking for money up front, because we're doing this to be able to set up and establish generational wealth. And the only way you can get there is by being consistent over a very long period of time. Now, personally, I've seen gains. I've realized a lot of gains in the short period of time I've been investing, the 2 years. But not everyone is going to be geared towards looking for these growth companies, right? But that does not matter. You're not really trying to compete against anyone. Your competition is yourself, and just stick with that and focus on what you're doing and not worry about everyone else, because it's just a lot of distraction to you. But anyways, I want to end the video there. Thanks for watching again. Peace out.